Hey everyone, Manny here. Thank you for joining us on The Weirdness of Money. Today I have a really good friend of mine, Max Schmitz, and he's going to talk to us today about disability planning and insurance. Max, welcome to the show.
Thank you.
Go ahead and give us like a little bit of background on who you are.
I'm a disability insurance and long-term care insurance specialist. We're focused on disability, long-term care, critical illness, a little bit of life insurance in there, but really what our specialty is in the disability side of things. So that whole spectrum of what do I do when I'm just starting out in my career? What sort of disability planning do I need to do? All the way down to, I retired 10 years ago. What sort of disability planning do I need to do? And then everything in between. We're using a variety of different insurance solutions, but it's all predicated on insurance. To me, it feels so corny to talk about like being a third generation disability insurance planner, but that's what it is. I mean, my grandfather started the agency in the 70s. He had some heart conditions. Things got pretty serious, and my dad he was a park ranger on Angel Island, and told him, "Hey, get to work." He figured it out, realized the potential, the opportunity, and the need for people. He and my mom really built the agency together over the next 30 years until my mom actually, believe it or not, had big mass on her spine that was really kind of destroying everything around it, including, her lungs, her spine. It was eating through the bone. She was really in a dire situation. They were able to get the mass out, but her lungs never quite recuperated. She ended up having a lung transplant in 2020. That's when we saw the real effects of the disability insurance kind of kick in. We were able to turn that on, knowing that this was going to be a long-term disability scenario. You get the note from your doctor saying you can't work anymore. She files the claim, they pay it out, and that was great to replace her income. But what it also allowed our business to do is not have to find a creative / potentially illegal way of trying to continue her salary, because we have her money still in the business and we can go and hire a replacement. She's doing really well, but she'll never be back to work. And so that's one of those things where, we saw it firsthand after doing this for so long and realizing, wow, there's so much more of a ripple effect that happens when A, you lose your income, but also B, when you have it, you're able to replace it. There's still going to be those crazy, life events that happen, but it's good to have the income replacement when that kind of stuff occurs.
In my experience, I feel like a lot of consumers don't even know that this is something they need.
Absolutely. I mean, there's the insurance industry, the financial advising industry. We kind of walk that bridge between financial advice and employee benefits sometimes. Really comes down to like identifying the family household dynamic and determining what gaps and what risks are out there. Because the one thing that I think a lot of people think about when they're talking about disability planning is like the catastrophic disability and what that means. If you can never work again, there's all kinds of safety nets and things that you can fall back into, which is great, but it doesn't really cover the more routine type of disability. And I put that in quotes because it's nothing is routine, right? This is all unexpected stuff that happens. But the value of having an income plan while you're going through what I would consider, and how I like to talk about it, is really more like a medical leave type of scenario where you need to take some time to recover and get your health in order, whether that be from cancer, mental health, addiction, MS, ALS, you name it. There's some really serious conditions, and there's some where you just need a couple months, couple years to really kind of get your house in order. And during that time, there may be a significant income loss. And if you're going to be self-funding, you're typically cracking into your 401k or some other, big retirement savings account, hopefully big. In many cases, it's not yet. And in that scenario, you've basically just turned your retirement savings into like a slush fund. And so that's what we're trying to avoid, because what happens is if you're building it up, and then you have to take out a good amount, you're starting back down from here. And then you have to build up. Whereas where you could have been if you had income the whole time versus where you ended up 40 years down the road into your career potentially, that's a huge delta. It could be as big as 75% if it happens early in your career. So we want to make sure that we're addressing that exposure, because that financial exposure could really be the difference between you retiring on time or even early versus having to work potentially the rest of your life to meet your lifestyle needs.
Yeah, absolutely. So, okay, that makes sense to me. I'm trying to put myself in the shoes of the person who's like, okay, now I need to like tap into this income. Something happens, they've depleted their emergency savings, and they're looking at that 401k like that might be the solution for their income needs. Your solution, or what we're going to talk about today, is what we can do in between that last resort of dipping into retirement savings.
Exactly. Yeah, and that's a perfect way to frame it up. We do want it to be a last resort, and not a first occasion, because that's really the only fallback for most people if they don't have a plan set up. And there is a big gradient there, right? If you have some sort of group or employer sponsored plan, then that is something that you should definitely be utilizing in that scenario. That's not going to be everybody. Like a lot of business owners, entrepreneurs, they don't have their own
Mm-hmm.
stuff, right? You
Mm-hmm.
don't have a group to help negotiate price and stuff like that. And even with the group stuff, there's plenty of inadequacies that I think people just need to be aware of, and make the right call for themselves based on their risk tolerance. What is it that we need to do? Do we need to supplement? Are we good with just the bare bones here? And we can get into all that if you want to. But
Yeah,
um,
let's do it.
as an insurance person, somebody who's been brought up in this business, and that's all we do. The natural disposition would be to say, you need insurance. Everybody needs disability insurance. And
Sure.
while I do strongly believe that everyone should at least take a look at it, there's a lot of people who are going to be comfortable enough to find other ways to cover that income need if they need to step away from work. The statistics are a little bit, I don't say them to make anybody unnerved, but it's worth at least sitting with it for a second. And that's understanding that 1 in 4, according to the Social Security Administration, 1 in 4 people entering the workforce today are going to experience a long-term disability during their working years. We're not
Mm-hmm.
talking about term life insurance where it's like a 1 in 1,000 odds, or even the odds of totaling your car, or having that, catastrophic homeowners claim. All that stuff is in the hundreds. We're talking about 1 in 4, which is really a
Yeah, that's a
significant.
very high likelihood.
It is, as far as insurance goes. And so I think it's important to kind of sit with that and just have that as sort of a
Sure.
framework. We need to at least understand that this stuff happens to people all the time, but it's not like a death. Everybody's rallying, talking about this person.
Sure.
You see the GoFundMe's and everything to fundraise for their kids if they left their
Mm-hmm.
kids. It's not quite that visible. And you do see a lot of GoFundMe's for disabilities and health events these days. They're super sad. It's really sad from where I sit as well, because I know how attainable this stuff can be for people. And that's what really makes me the most activated to try to talk about this stuff with people. It can happen. I see a lot of these fundraisers. I like to read the fine print and see what's happening. And sometimes it is medical expenses, but more often than not, it's really just to cover their basic lifestyle expenses, to help pay for the
Yeah.
mortgage, to help pay
Yeah.
for the kids' school, or, the travel expenses to get to and from the Mayo Clinic,
Yeah.
or some sort of specialist that they need to see. It just stinks that that's the stuff that disability insurance is designed to pay for. And I've heard people kind of frame it up this way, in that it's the other half of the health insurance plan. If you think about it, the health insurance
Right.
just goes to pay the nurses, the doctors, the pharmacy. None of the health insurance goes to pay you. That's where the DI kicks in. If you're bought into this idea that you may need health insurance at some point, you might also want to complete that plan and also understand that nobody's going to come to your rescue necessarily,
Mm-hmm.
unless you're able to get in with a charity if you have a very specific ailment. I've seen that work for from a fundraising perspective in
Yeah.
some cases. And then you could go the old fashioned way and have some type of bake sale or event
Yeah.
that could help pay for some, or defer some
So when
costs.
we're looking at it, we really should be looking at it as like income replacement. Like you're sick now and you need to recover and you're out of the workforce and you've depleted your emergency fund. Health insurance doesn't cover the life costs. And so that's when DI disability insurance would kick in.
Yep. Exactly.
Okay.
Some people have referred to it as income insurance. Income replacement is a big one. Livelihood insurance is another one that I like. I don't use it often, but I do think that kind of hits it home to kind of associate with your occupation, your livelihood, and your ability to do what you have to do on a daily basis to serve out your purpose in life. We also addressed a little bit the liquidation stuff. You can look at your retirement savings. That's where most people go first. If it gets really
Mm-hmm.
crazy, you could sell your business if you're a business owner. If if
Hmm.
it's going to be like, we need this money and we don't know where else to go, you could liquidate and use the equity from your home. Never a good decision. That's probably even more last resort than retirement savings, but
Yeah,
don't know.
absolutely. Everything you just mentioned there, these are huge life decisions, and they are impacted by this inability to meet daily living expenses because there was no insurance to replace the income that you had once received. Yeah, it is unfortunate. Where do people turn for assets when it comes to that? I'm from a Filipino family, right? And so there's a really strong network that we've kind of built in, and like we show up for each other when we can, but that's not everyone has that.
I won't pretend to know anything about how that network operates, but I would wonder if there's kind of an expiration date on that too. Not, I don't
Oh,
mean that like
absolutely. Yeah.
backhandedly, but it's like 5 years of helping somebody, 10 years of helping somebody. It's like, okay, when are we gonna help you get your own footing here? So
Yeah.
that's
Yeah.
what this stuff is designed to do as well, is to give you that longevity for those income needs that you really need to plan for too.
Yeah, you bring up a good point because I guess in my example, it's more like an acute need, and
Sure.
what you're offering kind of just sounds like a longer term solution. So, okay. So, people usually get this type of coverage through their employer, don't they?
They can, certainly. And that's super common. I'd say bigger groups and stuff. For small employers, if you're working at somewhere that has less than 50 employees, I think generally it's not going to be one of these kind of stacked benefits that are just part of your packet. And you're like, okay, cool, whatever, move on. What they are overlooking is the fine print in those. And there's a few things. I mean, it's good to have this stuff. I don't want to get that twisted at all. It's great to have an employer sponsored plan because it means the employer is paying the premiums. You just
Mhm.
collect the benefit when you need this stuff. I do want to underscore though that this type of plan really does benefit an employer. I wouldn't say the most necessarily. It's great for the employee too when you do need that long term disability,
Mhm.
but let's not undervalue the need for the employer to have a plan like this because it really outsources a really big decision for them, which is if this employee that we value is not going to come back in the near future, we don't know when to cut them off. I think there's kind of this sense that big employers view employees as disposable. And I'm not going to argue
Mhm.
against that. I think that is absolutely the truth for a lot of employers. But a lot of them do wrestle with that decision because when do they have to make that call? When to cut somebody off? Like they're not a physician. They don't know how long this is going to go on for. And so, if it's 6 months down the road, they're like, man, we can't keep paying you anymore. Like we need to make sure that the revenue's staying in the company or at least get some output from this relationship. And so it helps them basically outsource that decision to a long-term disability carrier where they say, you know what, we're going to cut you off, but if it is a quote unquote legitimate claim, then they'll take care of you from this point going forward. So that's great for the
Mhm.
employer. The other thing is they get to deduct all the premiums, right? From a tax
Mhm.
perspective. If you're making,
Quick
let's say,
question.
oh yeah, go ahead.
How long typically does an employer keep someone on before they're like, we got to find another solution here?
Yeah, it should always be defined in a salary continuation plan. And that's where a lot of people just bring in one of these group plans and then it'll
Mhm.
say, all right, we'll come in and start paying benefits after the third month. So maybe the employer's saying, well, we'll pay you for 3 months. Maybe it's just 2 weeks, and then they have like a short-term disability plan that kicks in for a few
Mhm.
weeks before the third month kicks in, and the long-term disability plan takes
I
over.
see.
It's really contingent on a couple things, but for a small employee group like my agency, everybody's kind of got that 3 months sort of worked into the deal here. Just give an example really quick. So say you're making 240,000 a year. I'm doing this because it's actually easy math. That's $20,000 a month, and you're at Google, Meta, Amazon, whatever, and if your employer sponsored plan is going to cover you at 66% of your earnings up to 15,000 a month, well, you'll get 2/3 of your earnings at that point. If you have any bonus or incentive comp or anything beyond that base salary, though, none of that's going to get covered. This is just a base
Mhm.
salary plan. And that's
Okay.
how virtually all group plans work. So anybody who has that
That's
incentive
quite a
comp,
big delta,
oh yeah, it
right?
can be. It
Yeah.
can be huge. Yeah. And it's just straight up overlooked. A lot of people are not reviewing their benefits packets until they need to go out on a claim, or maybe they're expecting a child or something like that, and they're like, shoot, I meant to
Yeah.
look at this when I got hired and then I never did. And so that's the reality of the situation, is there could be a big gap there, and that 66% is great, but that's also taxable. That's the 66%, and then take off another, but let's just account for 20% of that. So now you're
Hmm.
looking at a total takeaway of maybe just over 50% of what you're accustomed to and what it
Yeah.
says on your
Yeah. That's
W-2. So
huge.
it's
That's huge.
yeah,
That's a
yeah.
major life change. And that's with coverage.
That's with employer coverage. Yeah, yeah.
Yeah.
So
Employer
what a lot of
coverage.
people can do is just plug in. It could be a small individual disability plan. What happens when you leave that employer is, unless you're going somewhere else with another group plan that you can automatically enroll into, you might not have any coverage, and you're in your late
Okay. So it's
40s.
not necessarily portable. Actually,
No,
most cases it's not, right? It just,
not
the coverage ends when you're no longer an employee.
exactly.
Are
Yeah.
there options usually where you can say, okay, hey, I'm getting laid off. Do I get to continue this pay, like insurance if I pay for it myself, or no?
Not typically. Nope, it doesn't work like health insurance where you can
Okay.
use execute Cobra and make sure you have access to something at the full price or anything like that. These plans are not to be taken on an individual basis. So it's
Gotcha.
just while you're at the group, serving the group. And of course, that's, doesn't mean that your employer can't cancel it at any time either. If things get, tight or what have you, that
Hmm.
could be a benefit that they chop, or maybe chop from your category of employee or something like that.
Sure.
So that's also something to be aware of too.
Yeah, there's a lot there that's in the employer's control and not a lot in the employees. So,
Right.
so what can we do?
So yeah, with that really basic individual DI plan, most of them have what we call benefit increase options that can allow you to boost your coverage if you lose your group coverage. So that's going to be done with no further medical underwriting up to age 50 or 55 typically. So that's
Hmm.
going to be a big benefit, a really kind of understated benefit from these individual plans, especially in the context of it being a supplement to a group LTD plan that you have through your employer. But yeah, so those are just kind of the common pitfalls of the employer sponsored arena, just stuff to be aware of more than anything. Because again, you can't really opt out of those plans. It's like an HR corn maze trying to get through that system.
Hmm.
So it's not something I really recommend unless somebody feels really strongly about it. Having the employer pay for the coverage is really great, and making sure that you have access to it is important. But there's
Hmm.
might be another layer that you want to just bring on, and it can be done
Sure.
very affordably.
So it's not a perfect solution. It's better than nothing.
Right,
Take it because it's offered,
right,
but know that there's going to be a delta there from what you're used to and what you actually receive. Okay.
right. And you bring up an interesting word, which is if it's offered. That offered term reminds me, I didn't address yet the voluntary employer plans, which means everything I've been talking about up to this point, assumes that the employer is paying the premium and that it's a mandatory plan. You're auto enrolled into that plan. They give you a benefits packet and you have your coverage. The employer pays for it. It's all good. No, nothing you needed to sign or anything like that. What happens with a voluntary plan, that's the one you do have to opt in for. And
Hmm.
typically you have to pay the premium that's auto deducted from your paycheck.
I
So
see.
that's very different. And the premiums are cheaper on those plans compared to going the individual disability route and getting your own coverage in the open individual market. But you're going to be stuck with the same salary language in many cases, the same inadequacies as far as some of the definitional stuff that we haven't really gotten into. For life insurance, doesn't matter, right? You're dead or alive, it's pretty black or white.
Sure.
But for disability, there's all kinds of gradients, in terms of how
Sure.
you
Yeah.
define your occupation, your substantial and material duties. And I don't want to overcomplicate this, but just understand there are some changes to the definitions in your policy if it's through an employer sponsored plan or a voluntary benefits plan through your employer.
If you work for the government, is there something different or
Oh, yeah. Good
or
question. Some local municipalities have the same type of group type of insurance. Federal employees usually have about 40% of their payroll covered. It's still worthwhile to look for a little individual supplement, but I would say for For teachers, firemen, policemen, people who work in that sort of public sector, it's going to be tricky to get something in the individual market. A couple factors there. The higher incomes, I think it's going to be a lot more of a fit in that scenario. If you're making less
Mhm.
than 100,000 as the government employee, you're going to have 40% of your paycheck and it gets vested all the way through. So it's going to be pretty expensive on the open market. It's going to be more than $100 a month, right? And on
Mhm.
an income in the Bay Area for 100,000, I think that just gets to be a bit of a squeeze, depending, right? It always depends.
Mhm.
But just realistically, we see it more for, people who are making, well over six figures in a government role, looking at some sort of individual supplement.
So we talked a lot about employed folks, but how about those that are self-employed? What's available to them?
Not a whole lot. If it's just one individual, you can get group coverage down to two lives. We've seen a bit of traction there in helping some groups get set up with that. One thing to be cognizant of if you do have like one employee is if that employee leaves, your coverage is gone. Right. So you need to fill that role really quickly in order to keep that plan
Mm-hmm.
intact. And we've just seen a lot of issues with that over the years. Really, three lives is probably the safest bet. But on the individual side, you can access some form of state disability that's going to cover you for up to 1 year. And that's guarantee issued, right? The problem is it's going to be pretty expensive. And this is something we should probably address for W-2 employees as well. If you are a W-2 employee and you live in California, you're already getting 1.1% of your paycheck deducted and paid into some form of short-term disability insurance. We call it California State Disability. And
Mm-hmm.
so that covers unemployment, that covers family leave. They have these new baby benefits and things like that, maternity leave, paternity leave, and now some caregiving benefits in there as well. So it's a really cool program. It's unique. It's definitely the most robust in all 50 states. There's like 3 other states that have something similar, but California's is the gold standard. There's some limitations to be aware of. For W-2 employees, even though you're automatically paying 1.1% of your W-2 income into this plan, your benefits are going to be capped to about 1,300. I think it's up to like maybe closer to 1,400 a week right now in
Mm-hmm.
benefits. So it's 75% of income up to $1,400 per week. So if you make more than 1,400 a week, or what is that? If you get a paycheck every 2 weeks, if it's more than $3,000, you're not going to be getting the full 75% of your income.
Mm-hmm.
And on top of that, it's going to stop after that 12th month, right? So 52 weeks is the most you can get out of that plan. And so you need to have something a little more long-term just to kind of safeguard against that. If you are making more than $6,000 a month, then you're going to want to look at a supplement anyways in the individual marketplace, even if it is just for that 1 year of coverage. But probably better to look at something more long-term down the road as well. So that's W-2 wage earners. For self-employed people, you can opt into that California State Disability Fund, but it's going to be much more than 1.1% of income. And that's going to be contingent on a few other demographic criteria, like what you do, what your age is, and stuff like that.
We're getting near our time, but what else should people know about disability insurance?
Really, if you're going to limit down to one question, are you dependent on your earnings? If the answer to that is yes, you should probably look into some form of disability income, whether
Mm-hmm.
it's through California, the state disability program, just become
Give me
aware
an
of whatever.
example of someone who isn't dependent on their earnings.
So that would be somebody who hits their retirement net, right? Like
Yeah,
somebody who is work optional. You
yeah,
see a lot of people talking about the FIRE movement, or at least they did a few years
yeah.
ago. I'm a little
I don't
outside of
know.
that.
It's lost some steam, that one. But
It's
yeah, so what I'm
less than
hearing
deep.
here is like if you are financially independent, let's
Right.
say you have a portfolio that's producing income for you, that portfolio is going to produce income for you whether or not you're disabled or not. If you don't have that and the money that you earn is the money you need to live, this is something you need to look into.
Yeah, at least a short term. And I like these 5 year benefits. I'm not going to lose sleep over setting somebody up with that plan design. There's a lot of DI snobs out there, believe it or not, in the insurance space who are like, no, you need to buy something to age 65 with inflation riders and just souping up these Cadillac style policies when that's
Hmm.
really not totally necessary for the bare bones to help people make ends meet. If you can buy some time, if you can buy 5 years, you're buying 5 years of time to understand what your next move is.
I
And
love
that
that. I
can
love
make the
that.
biggest
I
difference.
love that it buys you time. If you do become disabled, it's like you can potentially find another way to make an income. And I like what you're saying is like that 5 year runway, it gives you time, more time than none at all. So
Exactly. Exactly. Yeah. And it could be that scenario where you're finding something else to do, in which case those benefits will drop off as you start to earn more money. And that's getting into the weeds here, but almost every policy that comes through our office, I'd say 99%, if not 100, has some form of a partial disability insurance rider. So if you have a partial loss of income, it's going to pay a partial benefit. And so that goes the other way. As you recover from a disability and you get back to work, it'll continue to pay those benefits. Even though you're back to work full time, there's some form of a recovery benefit in there that's going to continue to
mm-hmm.
fill that gap. So that 5 years could make all the difference.
Yeah, I like that. I love giving people options. Yeah, giving people time to figure out what their next move is. What's the one thing you want people to walk away with after watching this?
Just know you have options. It doesn't have to be a hard decision. And truly, I think the biggest thing I would love people to walk away and understand here is that disability income is foundational to every financial plan. You've got to
Mm-hmm.
be planning for that. You can't run a Monte Carlo on a disability scenario necessarily. Just understand things happen to people. Again, not to scare, but that 1 in 4 thing is real. And we need to make sure that people are aware and understanding of the need here.
Well, Max, thank you so much for your time. This was
Oh,
great. You're my fourth ever special guest on the show, and I think
yes.
this went swimmingly. So, hope to have you on the show again. All right. Well, thank you so much for being here. If you liked anything, go ahead and like, subscribe, hit that notifications button. If you have a question for our expert Max here, go ahead and drop it in the comments section below, or you can contact Max directly and we'll have his contact information in the details below. So I wish you financial wellness in all things. I'll see you next time.
Thanks, man.
Bye.
Bye.
Bye, Max. See you later.
All right. All right, cool. Well, thank you.